It's time to get your portfolio checked, and for that, we have Gautam Kalia, financial planner, with us. Gautam, good evening and welcome to the show. We have the first query for you, which is from Deepak. And he says that he's been investing since last 5 years now, and he has collected almost 4 lakhs of corpus. In total, he needs 30 lakhs in next 10 years, and the purpose is his son's higher education. And he can also invest almost 30,000 per month. The kind of funds he has in his portfolio are SBI Small Cap, SBI Magnum Fund, Quant Small Cap.
Right. So Deepak, my response to you is as follows. If you put in 30,000 rupees a month for the next 10 years at a 12% growth rate, you're looking at a corpus value of 81 lakhs. So that's more than enough for your target of 30 lakhs. Even after we take into account inflation at 5%, because in today's money 30 lakhs after 10 years will be around 49 lakhs. So even inflation at 5%, you are of your target of 49 lakhs, you're looking at about 81 lakhs. Now we're trying to build a robust portfolio for you, and the funds that you have can be modified. Basis our research, you could probably look at the following portfolio. Put in 10,000 rupees per month in ICICI Prudential Blue Chip, 5,000 in Mirae Asset Mid Cap. You can continue with your SBI Small Cap SIP, but reduce the value from 10,000 down to 5,000. And add another 10,000 in Canara Robeco Flexi Cap. So this way you've got 30,000 spread across 4 funds, which you continue as a SIP for the next 10 years.
So that's the recommendation for Deepak, but we have Anil's question for you, Gautam, and he's just 10 years away from his retirement. So almost all of his investments so far is into fixed assets like PPF and fixed deposits. He wants to shift part of that money to equity mutual funds, and he wants to build a portfolio for the corpus of 50 lakh before retirement. So he wants to understand as to how can he shift that money to mutual funds, and he can shift almost 20 lakhs from his fixed assets as lump sums into equity mutual funds.
Great. So, Anil, what I would suggest is that because you're just 10 years away from your goal of retirement, moving 20 lakhs as a lump sum may be a slightly riskier option. So, what I would suggest you do is move it in the form of a systematic transfer plan. So, you start off by putting money in the liquid fund and then move it from there on a monthly basis into the equity fund, which is the destination fund that you want to invest in. So obviously it's a lower risk approach, but then if the market rallies, you kind of miss out on that rally because you're investing in a staggered manner. Obviously, if the market corrects, then you are investing at a lower value and the value averaging down. So which is good, but it's a less volatile approach to build your portfolio, and that's what I would suggest that you do with your 20 lakhs. What you should do is start off with a ICICI Prudential liquid fund investment with a systematic Prudential blue chip fund. Put a target of allocating 6 lakhs here out of your 20. Start with SBI liquid and move that to SBI large and mid cap fund with a target allocation of Kotak liquid to Kotak emerging equity fund, target allocation 3 lakhs. Canara Robeco Liquid to Canara Robeco Flexi Cap Fund with a target allocation of 4 lakhs. And put in a lump sum into ICICI Prudential Balanced Advantage because it anyway has a debt allocation to it for 4 lakhs. So that way you are able to deploy your 20 lakhs entirely.
All right, next question comes from Sumaya, and Sumaya says that she's in her first job right now and she wants to build a habit of investing in mutual funds, and right now she can spare around 15,000 per month for her investments. She wants to know what kind of funds would you recommend for longer term investment horizon.
Sumaya, so fantastic decision to start off saving so early. I wish I was as smart as you when I was your age, if only. What you should do is start out with 5,000 rupees in ICICI Prudential Blue Chip Fund, another 2,500 in Mirae Asset Emerging Blue Chip Fund, another 3,000 in Canada Robeco Equity Hybrid Fund, and 4,500 in ICICI Prudential Balanced Advantage Fund. This way, your total comes to 15,000. I have suggested a more defensive portfolio for you. Since you're new to the market, it'll take you a little bit of time to get used to the roller coaster ride it is. And then after some time, as you gain more experience, maybe you can replace some of these defensive funds with more aggressive options.
All right, so let's move on, and we have a live caller on the show, Mr. Shirish Kulkarni. Hello, Mr. Kulkarni. How are you doing, sir?
Hello. Yeah, very nice, very nice.
So we have your question, sir. Any other changes you would like to add?
I think I have explained quite elaborately.
Yes, you have.
What I have already.
Yeah.
And entire superannuation funds have been invested in the manner that I have shown it.
Mm-hmm.
And
All
I
right.
have a perennial income from my employers by way
Sure.
of monthly pension.
Sure.
I just want to know whether this is the right way to capital protection and hedge against inflation. These are the two areas where I would like to protect my income.
Definitely, we'll help you with that.
Rather than a huge growth.
Right, sir. Got your question. Thank you so much for sending this across to our show. And Gautam, over to you.
Online?
Mr. Kulkarni, thank you for your question. I think the key question you need to ask yourself is, because you're trying to find a balance between keeping up with inflation and not having too much risk in your portfolio. Obviously, you're 65 years, so you need to have some money as an emergency corpus, which actually most of us need to do regardless of age. So as long as you have that, because you indicated that you have investment in debt instruments as well, including fixed deposits. So that money is accessible to you, I hope. So really, I don't know how much money you have on the debt side. So if you have an equivalent amount on the debt side, like 60 lakhs equivalent, then I would say you're on the right path.
Gautam, what we can do is we can ask him how much money he has in his debt portfolio. So, Mr. Kulkarni,
Yes.
on the fixed income side, how much do you
Okay.
have collected?
10. I have though I have a low risk appetite,
Sure.
I have 10 on the debt.
Got it, sir. Gautam, I'm really running out of time. How could you help Mr. Kulkarni?
So very quickly, I think you should reduce your equity allocation and increase your debt allocation. It's a little bit too risky for you. If your 60 lakhs comes down with market correction to 40, so that may lead you to take some decisions which may not be in your best interest. So I would say reduce the volatility in your portfolio and increase your debt allocation.
Mr. Kulkarni, hope you've got the solution for your portfolio, and thank you so much for sending us your query. And with that, thank you so much, Gautam, for being on the show and helping our viewers with their financial portfolio.